There they go. Hello, everyone. We'll be getting started here in just a minute. We got lots of people coming in. Welcome, welcome. Okay, well, looks like the number of attendees has stopped growing. So we'll go ahead and get started. So thank you for joining us today. Very exciting time. Finally, associations and 501c6 organizations are included fully in the federal relief program. And so we've got a dynamic duo returning from our last session that we did back in April, I believe, that will be helping us understand what's going on with the Paycheck Protection Program and other programs that associations are now qualified to participate in. So I want to welcome first Jeffrey Tenenbaum is the managing partner for Tenenbaum Law Group based out of Washington, D.C., and he's been very active with CalSAE and many other state societies as well as ASAE. Shelley Laurel is a senior vice president and regional manager for Merchants Bank of Commerce. And Shelley has been incredibly active volunteer with CalSAE in the past, including a member of the CalSAE board of directors. So thank you both for joining us today. And then, of course, I'll be moderating the chat today, looking at those questions. We do have a ton of information for you today. We are going to be providing the recording of this webinar as well as all of the slides that you'll be seeing. And there's a lot. But mostly today, we want this to be an engaging Q&A with you to make sure that we are able to answer your questions moving forward. Now, the other thing I wanted to mention that's really good news that you might not be aware of is in the past, the old version of this required, you had to choose between the Paycheck Protection Program and the employee retention tax credits. That is no longer true. You can apply for both. So we're going to focus on the PPP first, and then later in the program, we'll be talking about the ERTC. So, but I was really, really pleased to hear that information. And then if we want to go ahead and share the screen, we'll go ahead and begin the slideshow. We just want to give you a quick update about what the agenda is going to look like today. So first of all, we're going to go over the PPP, as I mentioned, and the expansion, including 501c6 entities. We're going to look at the details related to eligibility and loan forgiveness, and that's a big one to remember. So applying is easy, but loan forgiveness is not, and you need to think about that going into it. We're also looking at the injury disaster loans and the ERTC, as I mentioned. And then there's some other changes to the rules for charitable contributions and tax deductibility in 2021. So we're going to be entertaining those questions, excuse me, throughout. So feel free. We want you to focus the questions on the chat box. I think that's probably the best way, but you can put them in the Q&A box as well. Sina Tate on our team will be managing and reviewing that Q&A box. So without further ado, let me again say thank you to Jeff and Shelley for joining us. And I'm going to turn it over to Jeff now to get us started.
Thank you, Jim, and good afternoon, everyone. Welcome to our webinar today. We have about 55 minutes. We have a massive amount of information to cover. You guys can't see the whole PowerPoint deck, but I believe it's 27 pages. Not intentionally trying to overload you with information, but there's a lot of information here. And I wanted to make the PowerPoint deck as comprehensive as possible so that you guys will have that as a reference going forward. We're obviously not going to be able to get into all of the details here today, but obviously feel free to refer back. There's a lot of detail in here. This was one of the more challenging PowerPoint presentations to put together because with this new Paycheck Protection Program, what I'm calling PPP 2.0, it's to analyze the rules, the eligibility, the loan forgiveness requirements, and everything else, you have to look at the new legislation. You have to look at the old legislation. You have to look at some new guidance that has come out from the Small Business Administration in the form of interim final rules. You also have to look at the original guidance, because a lot of things from the original program still exist. And if they haven't been modified by the new law, they remain the same. But a number of things, as we'll talk about, have been modified. One of the most important being, of course, that 501c6 associations are now eligible for PPP loans. So in the presentation, and then you also have to look to other things that are still unanswered. There are still going to be a number of open questions. Shelley and I may well get questions today that we just can't answer because we don't have answers to those questions yet. But we will obviously do our best to answer all of your questions. Please ask questions throughout the webinar. Jim is going to field those to us at appropriate times. Apologize in advance for the information overload, but that's the nature of this. I want to try to share as much with you as I can. And Shelley, the way we're going to do this is I'm going to walk through the presentation, and then Shelley's going to kind of chime in at appropriate times and offer kind of color commentary and additional insights and perspectives from her role as a banker, which is going to be very helpful, because this PPP program is administered through private banks like Shelley's, like Merchants Bank of Commerce. While the small business is kind of writing the rules and is the administering federal agency for the program, the whole application process goes through private banks, not through the SBA directly. And so that's why the role of bankers like Shelley is so critical here. So without any further ado, let's dive in. So as part of the Consolidated Appropriations Act 2021, which is the formal name of the whole big new COVID relief bill that was signed into law on December 27th, one section of that is the Economic Aid to Hard-Hit Small Businesses, Nonprofits, and Venues Act. And that's the part that we're going to be focusing on here today. That act contains a number of different provisions. One of them is kind of Paycheck Protection Program 2.0. So the act reauthorizes lending under that program, and it's a successor to the PPP 1.0 that was enacted as part of the CARES Act that I'm sure you all heard about last year. The overall PPP program here in this version 2 has $284.5 billion available, 35 of which is set aside solely for first-time borrowers. That doesn't mean that first-time borrowers will not be able to qualify for more than the $35 billion, but that's a set aside for first-time borrowers. And then $30 billion is set aside for loans made by smaller lenders and community financial institutions. And as Shelley will explain, there's kind of a phased rollout about the application process to try to give those kind of smaller lenders an opportunity first. The program is basically open to the smaller lenders first, and then will open to everyone else shortly thereafter. As I said earlier, loans are obtained. Sorry, that's a typo here. Loans are not obtained through. Loans are obtained through U.S. Small Business Administration approved lenders. I'm sorry, that's correct, and not through the SBA directly. That's in contrast to the Economic Injury Disaster Loan Program, which I'll talk about briefly a little bit later, which is administered directly through the SBA. You apply directly to the SBA for loans. PPP loans, and this is one of the great features of the program and why associations were lobbying so hard to get access to the program, is that these are loans, but they remain fully or partially forgivable if certain conditions are met. And we're going to focus a lot on the forgiveness requirements, which are critical here. Obviously, if you're an association and you want to get a loan to help offset your financial adverse economic impact of the pandemic on your association, you would certainly like to have the loan be fully forgivable if possible. And that's part of the purpose of today's program. And some of these, I'm just going to skip over certain of the bullet points in the interest of time. So here are some of the highlights of some of the things that are kind of different in PPP 2.0 compared to last year. Borrowers can set what's called the covered period of the loan to be anywhere between 8 weeks and 24 weeks after the loan is dispersed. And what that means is that you have to spend the PPP loan proceeds on eligible expenses, and we'll talk about what those are, during the covered period. You can only spend it on eligible expenses during the covered period. Borrowers that reduce their wages to employees or their employment levels during the covered period can lose loan forgiveness unless one of the safe harbors excludes those reductions. I'll talk about that later. In terms of eligible expenses, um, the legislation expands the pool of eligible expenses to include, in addition to what it included before, certain operations expenditures related to software, certain property damage costs, supplier costs, and certain worker protection expenditures. But this is important: to receive loan forgiveness, 60%, a minimum of 60% of the loan proceeds must be used on payroll costs. And that specifically means wages, payroll taxes, paid leave, healthcare payments like health insurance premiums, but potentially other things as well, retirement plan contributions. And this is new. All of that existed before, but the addition of group life, disability, dental, and vision insurance premiums are also included here. And then up to 40% can be used on the other eligible expenses. Some more changes. Of course, this is the big headline. Shelley?
We'll talk about more forgiveness in the back, but I wanted to comment on the covered period, the 8 or 24 weeks. Just a suggestion. I know there are people that are in much more dire straits than others and need the money sooner than later. So the 8-week period, when you can include all those other 40% expenses, is an option. But just one of the things, if you can get it all spent in the 24 weeks and just payroll, it allows forgiveness to be much cleaner. And when we go through forgiveness, just something to keep in mind, it's a whole lot easier if you can get the number of your PPP forgiven just under payroll.
Yeah, that's a great point. And I've read a number of other articles that other folks have put out about the new PPP program. Some of them mistakenly have said that it's either an 8 or 24-week period that you choose. The reality is it's a period anywhere between 8 and 24 weeks that you get to choose. It's not 8 or 24.
Yep.
Few other changes. Obviously, the headline here is that 501c6 organizations, and it specifically references Internal Revenue Code section 501c6, are eligible. And I say most, not all. I'll talk about that in a minute. Most of your associations are likely going to be eligible, but there are a few reasons why you potentially could not be, along with housing cooperatives, DMOs, and certain other organizations. The prior version did include entities to whom charitable contributions, tax-deductible charitable contributions can be made, specifically 501c3s and 501c19 veterans organizations. There's greater flexibility provided for seasonal employees, probably not very relevant to most of you guys. There is additional funding available for entities that returned their original amount or did not receive the full amount for which they qualified. And then this is important. You're going to hear a lot about this in the next hour. The law introduces this concept of first draw loans, and there's also been some misinformation reported on this. First draw loans, it's a new term, but it includes both PPP loans that were received last year under the CARES Act, as well as PPP loans received by first-time borrowers this year, like associates, 501c6 associations. And then there's this concept of second draw loans, which effectively, for those of you who are 501c6 organizations, the way the timing works and the fact that the loan application process is going to close at the end of March. Logistically, there's no way that you could qualify for a first draw loan, spend it down, and then qualify for a second draw loan before the program closes. So for those of you that are first-time applicants, you can pretty much ignore the stuff about the second draw. But for those of you, there are a lot of, at least about a third of associations are exempt under 501c3. Many of you were able to get first draw loans last year, and you would be eligible for kind of a second bite at the apple in terms of these second draw loans. Really the same basic construct in terms of eligibility and requirements, but the biggest difference is that the maximum loan limit for the second draw loans is $2 million compared to $10 million for first draw loans. And I'll explain how the loan limits are calculated and how they work in a little bit. So loans reopened. They did reopen on January 11th, earlier this week, with community financial institutions exclusively allowed to make the first draw loans. Second draw loans, again, for community financial institutions started on January 13th, yesterday. The PPP program is open to all participating lenders like Shelley's Bank at a later date. We don't know exactly what that date is, but Shelley's going to provide some commentary on that. And then one more point, and then Shelley, chime in, please. After March 31st, no first draw or second draw PPP applications may be submitted.
Yeah, like he said, on Monday it opened, and what it opened for was mostly very small, non-bank financial organizations. As of today, I got an update today, and as of today, banks under $1 billion are now open to submit, because there's an SBA portal, and the way it works, you have to have someone certified in the financial institution to be able to go to the what's called the E-Trans system for SBA. Probably too much information, but just so you understand, that portal is either open or closed. And so right now it's only open for those small institutions and banks under $1 billion. For example, I consider my bank a community bank, relatively small. We're $1.7 billion. We are expecting the over $1 billion bank portal to open sometime next week, probably Tuesday or Wednesday, with Monday being a holiday.
And like we saw in the first round, there was additional funding for the PPP program provided later in the year last year after the CARES Act was enacted. But the first time around, it ran out of money pretty quickly, and it's basically a first come, first serve. And
I did want to comment on that as well. Because for the second round, there are much more qualifiers. Last time, even though people and I know it's always in the news, but you had to certify that you're financially impacted. Well, the COVID effect was so new, nobody knew, you could answer the question, have I been impacted? We all were impacted. So I think also it was very much in the media. So even though we're getting requests, it's nowhere the frenzy that we were getting before. And just in perspective, there's $284 billion set aside. The first round last time was just about 300 million. The second round was something a little less than that, and the money went unclaimed. And from our bank's perspective, we had 450 requests that we processed in less than 2 weeks. And the second round, we had 100. So I'm hoping that the 284 will be sufficient. But like Jeff said, there could be additional monies. And the first time, just because of the sheer volume, the date from when you could apply, I wouldn't rely on it. But if there's money still available at that point, it would probably be extended.
Yeah, and I've heard a number of experts say that a lot of predictions that this money is not going to run out. It would be highly unlikely that it would. And in fact, I would not be surprised if, especially if the money hasn't run out, that the program gets extended, and the date's extended to be able to tap into it.
Yep.
We're going to be dealing with issues for a while. Okay, so first draw, eligible entities. I'm not going to talk about all these because they're not all relevant, but basically, and I'm sure this applies to most of the folks on the call, you have to have 500 or fewer full and part-time employees. So part-time employee, full-time employee, they're all counted as one, but you have to have 500 or fewer. As I said earlier, 501c3s and C19s continue to be eligible. This is obviously new here. The 501c6 associations and business leagues, chambers of commerce, visitors, convention and visitors bureaus, and destination marketing organizations, most of which are exempt under C6, are eligible. Restaurants, news organizations, etc. And at the bottom there, for any of those of you kind of in the arts world, there's this new Save Our Stages program that has a special grant program. And if you apply for and receive a grant under that program, you're not eligible for a PPP loan. In terms of 501c6s, as I said earlier, most but not all C6s are eligible. For C6s, there is for first draw eligibility, there is a lower limit in terms of the number of full and part-time employees. That's 300. And then there's this limitation on how much lobbying you do. And the way it's written, it was frankly, in my opinion, very inartfully written. You have to have not receive more than 15% of your receipts from lobbying revenues. Secondly, your lobbying activities cannot comprise more than 15% of your total activities. Likely refers to costs, expenses. And then your total lobbying activities do not cost more than $1 million during the most recent tax year that ended prior to February 15th of last year. The thing that's very unclear was, and I say here in the second bullet point, ASAE has requested additional clarification from the Small Business Administration and Treasury on kind of the scope and definition of lobbying activities. ASAE was actually pushing for SBA to use the Federal Lobbying Disclosure Act definition of lobbying activities, but for better or for worse, there's advantages and disadvantages to the various lobbying definitions under, for instance, the Federal Lobbying Disclosure Act versus the tax code definition under Section 162E, which I've always called the lobbying tax law. We have some reports that suggest that the SBA is going to, when they provide more clarity in this, which they likely will, they're going to point to Form 990 data in terms of lobbying, which means your lobbying tax law definitions of lobbying, which includes federal, state, and local legislative lobbying, grassroots lobbying, political campaign activities, and certain high-level federal executive branch lobbying, basically only lobbying like cabinet secretaries and their immediate deputies. Other regulatory and administrative lobbying is not covered under that definition. Again, for most of you guys, it's not going to be an issue. The other question is, what does that mean, receipts from lobbying? Most associations don't have special assessments to fund lobbying activities. Once in a while they do, for special lobbying campaigns, but generally lobbying is funded from membership dues and other kind of similar expenses. So there's not receipts like, for instance, a lobbying firm might receive for lobbying. So it's really unclear what that means, and it may be a moot point for most associations. And 501c6 sports leagues, and there are a number of those, are not eligible. Here's a slide. I'm not going to get into the details, but for those of you, and I know there's a lot in California, a lot of association management companies. This is nothing new. This was from last year, and the Small Business Administration put out a number. They put 3 different FAQ documents out to answer questions. One of them has this information, and it refers to what they call professional employer organizations, but for all intents and purposes, it's functionally the same as an AMC. In round 1, a number of AMCs, because they're for-profit businesses with less than 500 employees, they were able to qualify for PPP loans, but their clients, the associations, if they were exempt under C6, were not. Now we know that's different. The C6 clients will be able to apply for loans along with the AMCs themselves, for instance, getting a second draw loan. And this provides some of the mechanics of how kind of the association would get, because the association doesn't have its own direct employees. Obviously, it hires the AMC to do that. So this gives some guidance as to how the association would get the data from the AMC in order to be able to apply for loans. So let's dive into the details of kind of first draw loans, C6 organizations specifically, eligibility.
Hey, Jeff,
yes. Can
we pause just for a second here? I'm getting some questions. I think we've answered most of them. I just want to go over these couple real quickly. So one of them was, do you have to go back to your original lender for the second round?
You mean the same lender?
Yeah.
I don't believe so. I've not seen anything that would suggest that, but Shelley might have more insight.
Yeah. And I don't have any definitive answers, but I'm saying, I would say if your loan has been forgiven, no, there's no requirement. Because of the requirement to have either will or have used all of your first round, there may be requirements of, because the bank is going to be able to determine whether it's going to get forgiven or used. So that's yet to be determined. But if anyone had a first round, which probably not that many out there, it would probably be safer to use your original bank.
Okay.
Yeah. So no requirement, but it might make a lot of sense to do that.
Yeah.
Yeah, and just a little nuance on the AMC question. So before, AMCs were eligible because they were, private companies, but now the associations have the ability to get reimbursed for what they're paying for payroll costs through an AMC. Is that correct?
Correct. So basically, the AMC would provide to the association, here's your salaries and payroll taxes, that were paid during the relevant period, and then the association would use that for purposes of calculating, its loan amount.
Do we have any idea whether lobbying expenses are paid by or a related PAC would count?
So a PAC is a separate legal entity. They're generally tax exempt under Internal Revenue Code Section 527. They're separate legal entities. They're generally, I've never seen a PAC that has its own employees, at least not a connected PAC, which is what most associations have. So as a separate legal entity with no employees, it's not going to be counted here. But the one thing to keep in mind is that the definition of lobbying expenses under Code Section 162E, which is that lobbying tax law, that does include expenses paid by the association in connection with its PAC, costs to administer the PAC and costs to do fundraising for the PAC, which are allowable for connected PACs. I'm talking about the federal rules, of course. Those expenses do get rolled up along with your other lobbying expenses, so they would count toward that 15%. But other than that, whatever monies come in and out of the PAC are not going to be factored into, like contribution monies that come in and go out are not going to be factored into this analysis.
Okay. And then just to confirm for Stephanie, this is a first come, first serve. But as Jeff and Shelley just said, they don't think the money's going to run out, but it is a first come, first serve process. Then there was another question kind of related to the loan process. So one person was asking, what's the difference between when the loan opens versus the banks open for loans? So it's just understanding basically when we can qualify and when the banks are going to get the money.
Shelley,
Okay.
you want to take that?
Yeah. Well, there's a couple of things that I'm not sure exactly. Yeah, the portal for SBA for all banks and financial institutions will open. For example, our bank, we're finalizing our procedures Friday, and then we'll be ready to take applications. So as soon as the bank, so there's two things, SBA portal has to be open and the bank has to be ready to accept applications. And every bank it's been, at least in the first round, all over the map. I mean, we all heard the horror stories for some of the larger banks that you had to do it through an online portal and you had to wait for your invitation to apply. So, versus, we're going to send out applications to the people that have requested it. And then the first come, first serve comes with those coming in from that financial institution, but then it's also the funding is first come, first serve from when it hits SBA. So it's hard to give you an exact, but just know, at least in my world, and not just my bank, but everybody mostly in the community bank world are trying to do this as quickly as possible. And again, yeah, there's no guarantee that it won't run out, but the process, it's, even though you want to take care in your application, the sooner you can get the application into your bank once the portal opens, the better.
Yeah.
We'll also talk about, you want to be checking with your bank, because as we get down the road and we talk about the forgiveness side, that has been an amazingly horrendous process for banks, especially smaller community banks, because it is there's so much time that it takes to do this. Because we talked earlier about, this is not something you apply through SBA, you have to go to a bank. It's because the SBA could never have done this. It is very work intensive. And so on the forgiveness side, a lot of banks are so overwhelmed, they're choosing not to do loans on the second round. So you want to make sure you do check with your bank, because I've heard of a couple of them out there, and maybe they'll acquiesce, but I have heard a handful of banks in this area, in Sacramento at least, that are not going to do a second round.
Jim, we should probably hold off on questions for right now, because we have 30 minutes left and we got a lot to cover still.
Okay, keep pounding away.
All right, so this is the eligibility criteria for a first draw loan. One, that you did not receive a PPP loan under the CARES Act, or that you now qualify for an increase of your original PPP loan amount. Requesting an increase in your original loan does not turn this into a second draw loan. As I said earlier, 500 or fewer employees. The applicant must have been in operation as of February 15th of last year. We had this question last year a few times about, can we form a new entity and qualify? And it's very clear here you can. If you weren't in business as of February 15th of last year, you don't qualify. And then this is important. There's this necessity test. And I advised a lot of clients last year on this. You have to certify under penalties of perjury in good faith that the PPP loan is necessary. And what that certification means is that you're certifying that the current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. And you have to take into account your current business activity and your ability to access other sources of liquidity sufficient to support the ongoing operations in a manner that is not significantly detrimental to the business. What we've learned from SBA since last year, since the initial discussions about this, is that it doesn't mean that you have to, for instance, have exhausted other loan opportunities or something, but you do have to show that you're economically adversely affected by the pandemic. And it seems like a no-brainer for a lot of associations, and for a lot of associations, unfortunately, it is a no-brainer. But we have some clients that have done better, in 2020 than they did in 2019 because they've been able to, various reasons, smart business planning, some good luck, or the place that they might find themselves where they've been able to actually do really well, make a lot of money off of virtual conferences. They had great event cancellation insurance coverage that covered pandemic-related losses for various other reasons. And there are, even in the first round, there were some organizations that decided they could not in good faith make that certification. So keep that in mind. That is a requirement. It's not, there's no more detail than this. Then the necessity test, it is what it is. It's right here. You're looking at it. There's no more detail, but keep that in mind. For second draw, eligibility criteria, as I said earlier, 300 or less employees compared to 500 for the first draw. And then here, the eligibility criteria are a bit tighter. Here, it's not just, that necessity test still applies, but in addition, you have this, this is essentially a more specific codification of the necessity test for second draw loans, in that you have to have experienced at least a 25% revenue reduction in 2020 as compared to 2019. Basically, you can either pick one quarter in 2020 and show that you had a 25% revenue reduction compared to the prior year, 2019, or you could compare the whole year, whatever works best, but you have to do one or the other in order to qualify for a second draw loan. And then also you must have used or will have used the full amount of the first draw loan on or before the expected disbursement date of the second draw loan. And then of course the full amount of the first draw loan must have been spent on eligible expenses.
And you might check with, if you are doing a second draw or a second loan, you might check with your bank and their requirements, because as we see, that's very loosely written. What does that mean? It means that in some cases, you're going to need to have provided at least some information to the financial institution that you've used all the money before you can have a second loan.
Yeah. So there are a few categories of excluded entities. This does not apply to first draw loans, but it does apply to second draw loans. A business that is primarily engaged in political activities or lobbying activities, including think tanks. This was a very deliberate exclusion that was written in here. It is not generally going to apply to most associations. Primarily, is generally referred like for tax code and other purposes. Usually means more than 50%. Essentially, if you are primarily a lobbying organization or primarily engaged in political campaign activities, like a 501c4, and C4s aren't even eligible here anyway. You would not be eligible. But even there, if you were spending 50% or more of your expenses on lobbying, you wouldn't meet the 15% limitation regardless. Certain entities organized under the laws of the People's Republic of China. The thing to keep in mind here, I actually had a client last week that came to me because they have a board member who's a Chinese resident on their board. And the way this is written, I'm not sure this was intentional or not, maybe it was, but if you have even one member of your board that's a Chinese resident, you would not qualify. Also, certain other categories here, which I'm not going to get into. So the loan amount, how do you calculate the first draw loan amount? And this is essentially the same for second draw loans as well. So I said earlier that the maximum loan amount is $10 million, but for virtually every association, you're never going to get close to the 10 million. It's the lesser of this calculation or $10 million. And this calculation essentially means 2.5 times your average monthly payroll costs. That's essentially the rule here, that's the amount you can borrow, 2.5 times your average monthly payroll costs. And this talks about how you calculate what those aggregate payroll costs are. And you have an option. This is what the law calls the reference period. You can choose calendar year 2019, 2020, or the 1 year period on the date before the date on which the first draw loan is made. You choose any of those as the reference period. Of course, you're going to choose whichever one has your highest payroll costs. You back out any compensation to employees that's in excess of 100K. You divide it by 12 to get the monthly amount, and then you multiply that monthly amount by 2.5%. So that's how you calculate the maximum loan amount. And then this talks about the same thing for second draw loans. There is this provision for second draw loans that is getting at the perceived abuse that occurred in the first round last year, where a number of different, for instance, like entities, like privately owned, like franchisees of a larger franchise and things like that, part of a corporate group. There's an overall $4 million limitation. The way it's written, it has all the language that refers to for-profit entities and ownership. It's unclear if it applies to nonprofit organizations, but if you happen to be in a situation like that, something to pay attention to. Now, once you that's how you calculate your loan amount.
I wanted to jump in here real quick about the EIDL loans.
Sure.
Previously in the first round, we found out the hard way when we were getting funds from the SBA, because nobody said anything. If you, not a loan, but if you had an EIDL advance, they were subtracting that from the forgiveness dollars. That has changed in this go round. So because you still can have a loan, and the advance is not subtracted from your forgiveness amount. So that was a big thing. Because last time they were taking those funds away from any forgiveness dollars.
Yeah, and the advance amount is $10,000.
Yeah.
And here, I didn't cover this last number 5 here, this bullet point, but if you did get an EIDL loan, and a number of 501c6 entities did, I'll talk about EIDL loans in a few minutes. The requirements have tightened up such that most associations would not qualify anymore anyway. And it's not nearly as desirable because they're not forgivable. But if you did get an EIDL loan between January 31st and April 3rd of last year, you can refinance that amount into your PPP loan, which could then become forgivable. So what can you use the funds on?
Hey, Jeff, one quick question. As far as some people are asking questions about demonstrating the need. So if you've got like good liquidity or reserves in the bank, but obviously your revenues have decreased substantially more than the standard requires, you can still apply for the loans, right?
It's a great question. I remember last year, probably, I don't know when it was, March, April, or May, I gave a presentation to a bunch of CFOs of kind of large conservation related nonprofits, most of whom have some pretty healthy assets. And that was a big point of discussion on that. Some of their CFOs decided that they just didn't feel in good faith that they could move forward, even though they had experienced a drop in revenues compared to the prior year, because they had so many assets, net assets, they just didn't feel that they could in good faith make that certification. We don't know is the answer. We just don't know the answer to that. I would say though, and I know many organizations that did apply, if you've had a significant drop in revenues, if you use that second draw standard of 25% compared to last year, remember that standard doesn't apply to first draw loans. You could have had a 15% reduction in revenues. I think you can still make a good faith argument that you meet the necessity test and that you shouldn't have to dip into reserves that you wouldn't typically be dipping into. But I can't tell you that for sure. And we're really never going to see any of that until we get to like these audits on the back end of this stuff.
And actually, we're seeing the audits come through. And in the news in public it said audits of all loans over 2 million. But we're getting randomly loans, mostly, they're over 100,000, but they are a lot smaller than the 2 million that they've talked about. But the ones that we've seen, and you're right, Jeff, we've had customers that they read that and everybody interprets it different. But so far, no one's been challenged, even if they had reserves, and I think any 501c6 trade association nonprofit that has been severely impacted in their world, even if they still have reserves. And, we're not out of the woods yet. I think there is a good case that, I wouldn't want people to not apply because they have some cash reserves.
Yeah,
You know,
I
I
agree.
think it is everybody's individual call, but you know, I think if you've been impacted, so far, the ones we've seen, we had a very large loan just pay off, and they had reserves, but they were impacted in their revenue.
And I have not heard of any audits that have resulted, in some sort of requirement to pay back the loan or give it back solely because of reserves. So far,
Okay.
that's kind of the advice that I've been giving.
Yeah, so the answer is apply for it now, and if you have to pay it back, you have to pay it back. But if you don't get it, you can't get it.
And you know, the perspective of some customers, it's a 5-year term at 1% interest. I mean,
Right.
it's still a really good loan if it doesn't get forgiven.
Yeah.
Okay, go back to you.
Let's move on. All right. So what can you use the money on? You can use it on payroll, rent, covered mortgage interest, and utilities. That's from the prior law. The new law also expands the definition. I talked about this earlier of eligible payroll costs to include the life, disability, dental, and vision insurance premiums. And this is retroactive to any prior loan. So if you had a first draw loan last year, you're actually able to go in and amend your loan application to get a larger amount as long as your loan has not yet been forgiven. Also covers, and this is a little more detailed than you probably want to know, but covers worker protection and facility modification costs, including PPP to comply with COVID health and safety guidelines, property damage costs related to property damage or vandalism and looting that occurred in 2020 that were not covered by insurance, expenditures to suppliers that are essential at the time of purchase to the recipient's current operations. That is going to apply to most associations. And then covered operating expenditures, not all operating expenditures. It's a very specific list that you can see here. I'm not going to get into the details. The loan terms. So while these loans are forgivable, if for whatever reason it's not fully forgiven. Go ahead.
Yeah, we're getting several questions around employees and such. One of those is around contractors. So if you have like a 1099 employee as a contractor, would they be able to count towards the use of the funds or to calculate the loan amount?
Yeah, first off, if it's a 1099 contractor, it's not an employee by definition. It's an independent contractor. That does not count toward payroll costs. And as I said earlier, and I'll get into it again, you have to spend at least 60% of the loan proceeds on payroll costs. And that is only related to employees. It's payroll plus a lot of related things like health insurance and whatnot. So you cannot count independent contractor costs in that payroll cost definition, which has to be, again, at least 60% of the proceeds. But for the other 40%, or up to 40% that you can spend it on, if it meets the second to the last bullet point, expenditures to suppliers, again, not every independent contractor is going to be considered a supplier, but some will be, that are essential to your current operations. It might well fit into that category or any of these other categories here. It could conceivably fit into the facility modification expenditures. It could fit into the last bullet point there, but in and of itself, it is not included in payroll costs.
Okay. Now, the other question is, if we're hiring new staff, would new hire expenses count?
Why don't we wait on that? No,
Let's say that one. Okay, fair enough. And then Jennifer, we'll get back to your AMC versus association question here in a little bit.
Okay. All right, here's the loan term. So as I said earlier, you choose the length of that covered period, anywhere between 8 weeks and 24 weeks, meaning the funds have to be spent on these eligible expenses during the covered period. And again, every association will do its different calculations as to whether it's in their best interest to have a shorter period or a longer period. In the first round, it was 8 weeks for everyone. This was changed for a variety of reasons, not having to do primarily with associations and nonprofits, but more for others like restaurants and whatnot that had to be closed for a while and they couldn't keep, the 8-week period was too short, saying, how can we spend money on employees when we're closed and we're not even operating, that sort of thing. It's 100% guaranteed by SBA. No collateral is required. That's important. No personal guarantees are required. 1% interest rate, 5-year maturity period. And then you see this last bullet point. Anything to add on that, Shelley?
Yeah, and just for the period of when the loan is made until it's forgiven. And so you have, once you have got your covered period, you have 10 months to apply for forgiveness. In that time period, the SBA is not requiring payments. So there is no payments. That they actually cover the interest to the banks in that time period. So just, once it's booked, there are still no payments until it's either forgiven or denied to be forgiven.
Yeah, good point. Okay, now loan forgiveness. This is really important. And it's the same rules for first and second draw loans. So here, the first bullet point kind of covers the basic construct here, which is that these loans will qualify for full loan forgiveness if during that covered period following loan disbursement, A, employee and compensation levels are maintained during the, meaning that they don't go down during that period. Second, the loan proceeds are spent on payroll costs and other eligible expenses. And C, at least 60% of the proceeds have to be spent on what's defined as payroll costs, but the remaining 40% or less spent on these other eligible expenses. The second bullet point, I've already covered what the payroll cost means. The third bullet point I've already covered in terms of what those other eligible expenses are. And then there's these two safe harbors. So the rules, the interim final rule only really refers to the last one as a safe harbor, but they're both effectively safe harbors. So it says that borrowers have to attempt to keep the same number of employees to the extent possible. A reduction in over 25% of salaries will result in a commensurate reduction of loan forgiveness. So if you have a reduction of over 25% of salary, then you're going to have a commensurate reduction in the amount of loan forgiveness. But if the reduction is less than 25% of salaries, there's going to be no reduction in the loan forgiveness. That's a very important safe harbor. It's going to apply to a lot of associations. And then secondly, the other safe harbor is that if a borrower cannot find employees to rehire, or if the entity is shut down due to COVID, the borrower will have a safe harbor and not be penalized in a reduction of headcount more than 25%. So getting back to that other question you had, I have not seen anything that would suggest that you can't, like if you let one employee go, but you hire someone to take their place and you're paying whatever commensurate salaries and whatnot, the headcount and the wages are still going to be the same. That should be fine. That should not adversely affect your loan forgiveness. Shelley, I'd be interested if you have any further insights on that.
Yeah.
But I haven't seen anything that says you have to have the same employees on the payroll.
No, because the application request, it will ask you beginning of the period, end of the period, number of employees, just number of employees. You certify, and then there's two qualifiers. If it's less, then number one, you take it's a longer, more involved forgiveness application. But no, there is nowhere on the forgiveness application that says, I changed employees, because we know that, that can happen.
Yeah.
So.
Okay. All right. And then for those of you with smaller associations, if you receive a PPP loan of $150,000 or less, there's a much easier, streamlined loan forgiveness process. This is piggybacking on something that existed for $100,000 or less loans in the prior law in the CARES Act. But it's become more clear here. And it's a great advantage to any of you smaller associations that are getting, relatively small loans like this. If you have small payrolls, and you're going to get small loans. If it's 150K or less, as you can see here, it's a very simple process to apply for loan forgiveness. It's got to be limited to a one-page certification form, certain attestations that you have to make, and then the certain record retention requirements.
This is really big, because the forgiveness application is a few pages or up to 15 pages, and in forgiveness, you are required to, what I talked about earlier, the onerous side, even though you certify it up front, when you go to forgive, the banks are having to verify everything, including, like, if you don't have a payroll company that you could do a payroll register from a third party, you're going to have canceled checks. Same for utility bills. So it can be a lot of information. So this is, I mean, the banks are looking forward to this as well, because of the back end amount of time it takes to get all the information. So it'll be a one page, and I'm hoping by next week. I really am. a one-page document certifying all of the things that Jeff has there on the slide. So and that's one thing to think about when you are doing your application. Make sure that you in your head or can verify that everything you're putting in as cost that you can document on the back end for forgiveness. It's very critical.
Yeah. All right, we got about 10 minutes left, so I'm going to need to kind of burn through the rest of this. This has to do with tax.
Yeah, Jeff, let me just ask you real quickly, because I think we do have more that we can cover. So I don't, are you guys okay to go a little bit over and maybe field some more questions?
Absolutely.
Okay, great. Thank you.
And we'll field as many questions as you guys want to stick around for, but let's get through the rest of this. This has to do with taxable businesses. So if you work for an AMC, this is definitely relevant and important and clarify. It's a change to what was in the case last year. Now, let's talk briefly about a couple other programs. One is the Economic Injury Disaster Loan Program. A lot of C6 associations did apply for these EIDL loans last year because they were not eligible for PPP loans. There was an additional $20 billion that was authorized for this program. However, while these loans have very favorable terms, they are, and I'll talk about those on the next slide, they're not forgivable like PPP loans. So if you're eligible for a PPP loan, there's really no reason to really consider an EIDL loan. And second, if you look at the fourth bullet point here, this is a new, much stricter eligibility requirement that did not exist last year. To qualify, you have to be located in a low-income community and have suffered an economic loss greater than 30% and not employ more than 300 employees. So that's going to kind of knock out a lot of associations to begin with. And then, like last year, there's this advance, they call it, of $10,000 that you can get that does not have to be repaid. These loans carry a 3.75% interest rate, 30-year loan period. You can use a loan for working capital and operating expenses. So it's a much broader array. You can almost use it for almost anything. Much different than the PPP loan. However, these are other reasons why this is not desirable and why a lot of associations did not apply for these last year. For loans over 25K, you have to provide collateral and you have to make a personal guarantee for loans over 200K. So most associations have no desire, most association executives have no desire to be personally guaranteeing loans for their association. So a lot of them that did applied for loans of less than that.
And a quick comment, just clarifying collateral for over 25, that would be, it's a UCC filing on all business assets. We've come in across this where it would affect your lines of credit with banks if you have it, because banks are going to want that for a line. So it's just additional. It's not like you have to put up a cash security, but it'll be a UCC filing on all your business assets.
Yeah. Okay, and then the last big topic we want to cover is the employee retention tax credit. So the new law clarifies and expands what is referred to as the ERC program. It applies to federal employer-paid payroll taxes. So this is applicable to associations and other nonprofits. You might think, well, we're tax exempt, we don't pay taxes. You don't pay corporate income taxes on your related income, but you do pay payroll taxes, employer-paid payroll taxes, generally 7.5% of the payroll amount. And so this is a very favorable program. A lot of associations, a lot of associations and other nonprofits did take advantage of it last year, including because it's a refundable tax credit if the credit exceeds the payroll taxes due for a particular quarter. And most importantly, this is a very welcome change that it used to be that if you had a PPP loan, you were prohibited from claiming the tax credit. That's no longer the case. You can have a PPP loan and claim the ERC credit. And another favorable thing is that the change is retroactive to the effective date of the original law for wages paid after March 12th of last year, meaning that if you took PPP loans and are now eligible to take the tax credit, you can do that so long as you can't count the same wages twice. You can't, so the tax credit cannot be claimed for wages paid with the proceeds of a PPP loan that have already been forgiven. So this is, definitely a welcome change. Here's the eligibility requirements. As of January 1st of this year, the credit's available to employers with operations that are either fully or partially suspended by a COVID governmental order and only during the period that the order is in force. Partially suspended is defined as operations continuing but not at a, quote, normal capacity. And then gross receipts are defined as having less than 80% of gross receipts for the same quarter in 2019. And for tax-exempt organizations, gross receipts includes all the things that are listed here. And finally, employers that were not in existence in 2019 can use a comparison to 2020 for purposes of the tax credit. Employer size limited to 500 or fewer employees.
Jeff, I'm sorry. I know we're at the bottom of the hour right now. We're very close to it. Sina or Lindsay, we are going to send out an email to everyone with these with links, but could you put in the link that gives access to people to the presentation? And then for people that have to go, you can copy it.
Yes, I'll put it in the chat right now.
Thank you.
Okay. So here's a few other details about the tax credit. I don't think I need to read through all these, but you guys can reference this. And then finally, there is another change for 501c3 organizations, including if your association has a related foundation. The CARES Act last year allowed non-itemizing taxpayers. Generally, you have to be you have to itemize your tax returns in order to claim charitable tax deductions. But last year, to incentivize charitable contributions, it allowed non-itemizing taxpayers to deduct up to $300 for an individual, $600 for married couples for contributions to qualified C3 organizations. That has now been extended through 2021, and the law also extends for another year the limits. There are limitations on how much charitable tax deductions you can take in a given year. It extends the increase in those limits. And then finally, the cap on charitable tax deductibility for food donations from corporations stays at 25% of taxable income. And then finally, and this is important, all of these are hyperlinked. So when you get a copy of the presentation, you'll see these all link to, and I want to get Shelley's comment on this, but this is all the kind of the core governmental guidance that I pulled from, in order to put this together, and that you should look at. There's the first draw and second draw kind of SBA kind of model loan application, which I'm presuming Shelley banks are using, as a starting point, a template for their own applications, but probably modifying it for their own purposes. And in some cases, I'm presuming adding additional, fields and information. Same thing with the loan forgiveness application, which has come out. And then there's the interim final rule for the first draw and second draw loans. And then that SBA COVID resource page has kind of links to all of this stuff, along with some other stuff, including the FAQ documents. And I'm presuming that SBA will come out with a new FAQ document, hopefully sooner rather than later, to clarify some of these issues. And then the EIDL loan application and the full text of the law.
And I was going to say, and being this is a group of trade associations, I have to say what we use as a resource to interpret and provide us information is NAGL. It's the National Association of Guaranteed Government Lenders. So it's a national association that actually tracks all of this stuff and boils down, because we know sometimes the stuff that comes out of the government isn't easy to understand. So that's another resource for you to get information.
Excellent. All right, Jim, let's open it up for questions.
Okay, I'm trying to filter these through here a little bit. So one of them had to do with employees. So this association back in March, everybody took a 30% voluntary cut in salary. Those were restated in January, reinstated. So they're back to 100%. Can the current PPP funds received now be used to reimburse employees for the temporary reductions they had?
Good question. It's an interesting question. So they should qualify if, 2020 compared to 2019, that reference period that I talked about earlier, they should certainly qualify, under the necessity test or even for a second draw loan. Can they use it? So you have to use it on payroll costs. I can't think of anything that would define payroll costs to somehow limit, regular payroll versus increasing comp to make up for cuts last year. And I think it should be able to be used for that. I can't think of any reason why not. But this is a good example of, there's nothing in the current interim final rules or the statute that would prohibit that. And I think it's probably, I think it's fine under the current guidance. But this is what we saw last time around. there will be FAQs that'll come out, and maybe even additional regulations like a final rule. This is an interim final rule. They will issue a final rule at some point, and they will address other things potentially like this. And they might, say something about a further definition of what payroll cost means. But at the moment, I don't think that's a problem.
Okay. Here's another one. So this association has a C6 and a C3. So the C3 is a subsidiary. They did get a loan that they expected to be forgiven. Now the parent is a C6 and is eligible. So can the parent make the first time loan request that includes payroll related to for all allowable subsidiaries, including the C3?
So we dealt with this issue. I dealt with that a lot last year. In most association related foundation structures, C6, what some people call the parent, and the C3, some people call the subsidiary. Technically, those terms don't apply here because there's no ownership. It's really what I refer to as a controlled affiliate, the foundation being a controlled affiliate typically of the C6. In most related foundation structures like that with associations, the C3 doesn't have its own direct employees. It just either has staff time kind of donated essentially from the association, or it reimburses the association the value of whatever staff time is spent on the foundation. And because of that, and because PPP is all about payroll, it's all focused on payroll, related foundations that don't have their own employees, even though they're C3s, they couldn't qualify last year because they can't spend 60%, on payroll costs. So in that particular question, I'm presuming it's one of those more uncommon situations where sometimes the foundations, I have a few clients that have this, they do have their own direct employees. And if they have their own direct employees, for instance, let's say they have 3 employees who are direct employees at the foundation and they work full time for the foundation, but then the foundation also uses other people, in the accounting department and meeting planning department and, HR and other things, general counsel, whatever, of the association who will spend some of their time on the foundation, and the foundation will reimburse for that time. If it's that model, and really that's the only way I think that question could work, is if it is that model, then the employees, like let's say the CFO, so he or she might spend some of their time on accounting issues for the foundation, but they're still on the payroll of the association. The association should be able to count that person, as part of their payroll costs. And so that can factor into the loan amount and the forgiveness calculations and all of that. But for those, in that example, those 3 direct employees of the foundation, they would not be able to be counted in the association account.
Okay, so now we're going to move into what I'll call the lightning round. So we'll just try to keep the answers very tight. Now, there was a question previously about why would anybody choose to be covered only 8 weeks? Doesn't selecting 24 weeks mean you just have more time to spend the money?
So I haven't really done a full analysis yet. I'm sure this will play out as
If you don't know, you don't know.
Counsel clients on this. So it doesn't change your loan amount. The loan amount is 2.5 times your average monthly payroll cost. You get the same amount. It's really a question of, are you going to incur enough expenses in that time period in order, because you want to maximize your loan forgiveness, right? Ideally, you want to get to 100%. And so it's really a question of, the calculations can be different for every association. But if you don't think you can actually spend the money on eligible expenses in 8 weeks, then you're going to want to pick a longer period. Yeah, Shelley.
Yeah, I was going to say, this goes to those people that might have had to cut their, they have the same number of employees, but they have had to reduce salaries. If you are keeping people's salaries the same and, nothing else has changed and the number of employees, you should be able to do it in 8 weeks. But if you've, like what happened last time, is a lot of people had to either cut back, lay off people, cut salaries, or like you talked about, Jeff, somebody that had a temporary furlough, like restaurants and hospitality, that then reopened, it gave them a longer time to hire back employees.
And that's why this was written that way. It's largely for the restaurants and folks like that. It's not really for an association. You're probably going to calculate, okay, what's the minimum amount of period I need to spend the money on eligible expenses? And that's going to be your covered period.
Right.
A question on the retention tax credit. So the calculation before used 50% of applicable taxes, right? So in my mind, that was covering half of year of those taxes. So now the question was, if you maxed out the ERTC in 2020, do the levels start over in 2021? So is it for that, what is the period in which those taxes are
Yeah,
counted?
so
that you
this is the slide that I kind of didn't really cover, but you can see it here. So that 50% amount was increased to 70%, I believe, in the new law. So this is a 2021 tax credit. This is not like it's retroactive, I don't believe, to last year. Qualified wages. Yeah, my apologies. It is. I thought I was wrong about that. The change is retroactive to the effective date of the CARES Act, which is March 12th, 2020. So I'm not sure what I'm not sure if I really understand the question, but the credit amount for 2021 has gone up to 70% of qualified wages. Frankly, I'm not as familiar with the nuances of the ERC. I haven't focused as much on this as I have the PPP.
So there was one other AMC question here. So a little bit confused here. So the employees aren't employees of the association, right? Do we just calculate the portion of the retainer that is applied for payroll costs that helps them apply? It would be great if we can get some help on that funding. So can the association use the amount that they paid the AMC to get themselves reimbursed, I guess?
No, it's limited to wages and payroll taxes. I actually had a question from an AMC client earlier today on this, and they asked if it included benefit costs, and it does not include benefit costs here. So the borrower has to obtain a statement. I mean, either you use the IRS tax form, or you just obtain a statement from your AMC documenting the amount of wages and payroll taxes. So the amount of fees that you pay to an AMC are going to be much greater than just wages and payroll taxes. Now, granted, that's probably going to be the biggest amount.
Right. They meant the portion of the contract that was going for the employees.
Yeah, but this fourth bullet point here, kind of talks about how you figure out that allocated amount. You don't get to just guess or something like that.
Yeah, it's going to have to be documented in forgiveness. There's got to be some type of documentation breaking it out so that you can provide that to the bank for forgiveness.
Yeah. And here, when we talk about IRS Schedule R, that's the filing from the AMC on its IRS payroll tax filing.
Yeah. So another one was on the is the EIDL considered another source of liquidity? In other words, if I got one of those disaster loans, can I now return those funds and get PPP funds instead, since the PPP is forgivable and EIDL is not?
Yeah, so you might have, questioner might have missed this, but if you look here at the last number 5 here, if you had an EIDL from last year that you received between January 31st and April 3rd, that you want to refinance, basically roll it into your PPP loan and then have it be forgivable, you can do that. You are allowed to do that for a first draw loan. I don't believe this rule applies to second draw loans. I'm not positive about that. And again, it goes because of this construct in some of the guidance. It basically says everything that was in place last year continues to be in place unless we've modified it. So it's a little bit unclear, but I certainly know for first draw loans, you can definitely do. And that's what's going to be the case for most associations, that you can roll it up. You just cannot include the $10,000 advance amount.
Mm-hmm.
Okay, and then somebody asked, yes, you have to go through a bank or your bank to get a PPP or these other types of loans. On the application itself, it says that to list all 20% owners. How do 501Cs answer that?
Well, you don't.
Well, we do this because all bank accounts have to have what's called a beneficial ownership certificate. And just like in those forms, it's not applicable. I mean, you can put NA because there are none.
Okay.
And that's acceptable.
Yeah. Of course,
now here's
for an AMC, it would be different.
Right.
Another EIDL question. So if I'm not quite following this, but if you do have an EIDL advance and a PP loan, can you double dip the EIDL advance and PP loan? Or do we need to show the EIDL advance funds and PPP loan fund allocated separately?
I'm not sure I understand the question,
Well,
but as you
yeah.
said before, you can't roll up, you can't roll up and refinance the $10,000 amount because it's not forgivable, the advance amount. You
Okay.
could do it for the rest of the year.
Well, the advance amount is forgivable. It was like an instant grant. It was from 1,000 to 10,000. That's a grant basically, and it's forgiven. Previously, the SBA was subtracting those advance dollars out of your forgiveness dollars. That has gone away. Also, for anyone on the phone that might have had one in a round one loan or first already, those monies, if they've already been forgiven and paid back that loan or are paying on that loan, the SBA is going to reimburse those people for those dollars. So
Okay.
it's just the advance, not the loan, because they did an emergency advance from 1,000 to 10,000. So those I even believe they're not including it even on the application form any longer.
And Shelley, are you aware if somebody did get a loan, is there
So
any penalty?
What kind of loan? EIDL?
And the IDL loan, yeah.
Go
Go ahead.
Well, but if it's even if it's a PPP and it's not forgiven, is there any penalty for paying it back early?
No, there is
No.
not.
Okay.
No.
All right, let's see what else we got here. Okay, we're getting to a couple. And so we talked about contract employees. Those do not count. There was another question about it says, I'm on a 24-week period for round one. Is round two covering the same 24-week period, or was that not covered? So I guess it's,
if they're talking about doing a second draw loan, you can set the period whatever you want, anywhere between 8 and 24 weeks. Doesn't matter what you did the last time.
okay. Okay, now let me go back to the bottom here. Not sure. So if you posted a question earlier in the last 45 minutes and haven't answered it, please repost it because there's so many of them. Yeah, I do actually think we've gotten through virtually all of them. So if anybody wants to post any more, I am at this point looking at the Q&A because there were 53 questions in there.
Good. Well, considering the amount of time, the limited amount of time we had, I think we covered a lot of ground. Yeah, and the PowerPoint hopefully will be a good resource for you, along with those resources that are linked on the last page.
And you know, the last slide had it has our contact information. Feel free to give me a call if I don't know the answer. I've got other resources as well to find the answer. So feel free to give me a call or email me.
Yeah. And then to John, yes, the max you can do is not just salary, but it's the 100,000 in total compensation, right? That's the cap for calculating.
Yeah, for calculating payroll costs, right?
Okay. I think we're good. Appreciate it, everybody. Again, we'll send out an email to you that includes the recording as well as the PowerPoint slides. But Jeff, Shelley, thank you so much. Lindsay and Sina, thank you for your support. Have a great day, everybody.
Thank you.
Bye.
You guys.
Bye.